Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel we call Trader Talks. For our next topic, building a stock portfolio. I'm your host, Kevin Horner. Thanks for being here, everybody, on this fine afternoon. We've got a number of key things to get to for you all today. We are going to kick off with a quick review of how the market finished today. Then we're going to move into a review of the example portfolio. You know, we haven't spoken in a few weeks here, in a couple of weeks rather, 2 weeks, since we last spoke in this class, and we've got some adjustments that need to be made to the underlying positions we're maintaining in this example portfolio. We've got some stop levels to raise and a few, and we're going to talk about that process through the beginning portion today with all of you. So thanks for being here. We'll, of course, then step in and place a couple of new example trades for you today based on our process for this class, and we'll elaborate on that a little further here today as well. We are joined by my friend and fellow Schwab coach, Connie Hill, in the chat. Connie is a CMT, a fantastic coach as well. Perfect individual to have in the chat for discussion that I'm unable to get to, but I'm going to keep an eye on things nonetheless, everybody. I'm happy to hear from you along the way. Bring your questions and comments into our ongoing discussion. That is always a great way to carry this class forward. So I'm happy to hear from you. Keep them coming, everybody. Now, if you're not already doing so, follow Connie and me on X, Connie Hill CS, Kevin Horner CS. I recently started posting on LinkedIn. You can find me there as well. And any follow you offer to me here on social media is greatly appreciated. That helps us out quite a bit. All right, let's get to those disclosures, everybody, and we'll get right down to business. So first of all, remember, everything we cover for you here today is informational and educational exclusively. We're not making recommendations. We're not endorsing a specific approach to trading. We are going to utilize technical analysis, though, as we discuss many of these trends we're looking at. We are going to incorporate some concepts and strategies that you traders might choose to incorporate as well. But remember, it's the fine-tuning of these concepts that are going to make your process personal for you as individually. Okay, it's very important that we get that comfort zone to customizing these details to our preferences. So very important that we all go through that. Now, as it relates to our platform here, you should know we work in a paper money version of the Thinkorswim desktop application, but some of the details that we may utilize in this class are not going to necessarily be available to you in paper money. Most notably, the scan tool, when we utilize and incorporate study criteria in the scan tool, that's one functionality that is not incorporated in paper money. And I'll try to reiterate that if we explore the scan tool with a little more detail. It was actually requested that I do that when we go through my breakdown of process in here for you all today, just to make sure that we cover all the needed steps. So we'll do that for you. You should also know, everybody, even though we don't talk too frequently about options, if I mention them, just remember that these are not appropriate for all of us as traders and investors. They do carry a higher level of risk, and we ask you to be approved prior to being a trader of options here at Schwab. So make sure you do go through your needed steps. But at any point we bring options up, we will remind you of some key risks if necessary. So with that, let's take a look at our S&P 500 today. We did finish in a green candle here today, so we know that we had a weak open, but bulls did maintain the bias this morning by buying up the low we found on Friday morning as well. So Friday we had this low there, and we came down basically and tested that short-term low and held. So we're going to see how things play out. But as you know, it's a big week. We got lots of companies reporting earnings. For those of you unfamiliar or maybe less acquainted with Thinkorswim Desktop, you can always find those details here under the calendar. So under the Market Watch tab and then calendar. But don't forget, you can customize this. So you can look at it based on the, as an example, you click this gear, you can do it for the positions you maintain. So you know when your stocks are going to be going into their earnings period. You can also change this to any of the public watch lists, like just exclusively the S&P 500 stocks. So this calendar is well developed and designed to make your life really easy when looking for earnings periods coming up. And then if you want additional information once those have occurred, don't forget, you've got the detail right here. If you wanted to look at this CNC, for example, you click the press release and then you get a pop-up window in a separate web browser like so, and it gives you the full detail. It's all here in Thinkorswim for you. So again, a real joyous platform to work with if you like this kind of stuff. If you're into the trading and you need all this detail at your fingertips, it's really excellent to have it here in Thinkorswim. So now, as it relates to the trend, a lot of traders still talking about the potential to incorporate a deeper pullback on the basis of earnings this week. So we'll see if that plays out, but we do have some important levels. We've got right here, right? We've got this one here, the gap ledge we tested last week. We've got the breakout level from 7,002, basically, essentially our all-time high prior to us breaking higher. You got that to work with if you'd like. You could also consider the 20-day moving average beneath as a level where you would manage risk as well. But as always, it's important that we individually manage our risk to our tolerance, to our comfort, not anybody else's. So some of you are already in sell-off mode. You've taken advantage of the recent rally higher to take your profits and move to cash and be a little more defensive, watching this rally develop. Maybe we just go sideways over the course of the next few days here. That would be perfectly fine if we can maintain some levels of support. The same can be said about both the NASDAQ 100 and the Russell 2000. Both saw weakness this morning. Both finished essentially close to, if not better, than we opened this morning. So you've got a little bit of a bullish lean, at least in terms of market posture. And what I mean is weak opens that don't stay weak, even though we are red on the day versus yesterday. The fact is, bulls were prepared and bought up the lows today. We don't mind that at all. Even though it's red from a change for the day, we like a day that finishes better than we started, especially on a weak open. We know the level that we rallied from. We've got the breakout spot right around 26,150, excuse me. Good area for potential throwback. We've seen this happen a number of times. So we're watching the same stuff. And again, there's some consistency here in the Russell. Man, do I have some lines drawn in. Let's take these lines off here. Clean this up a little for all of you. And notice we've got a more pronounced gap level here that could be easy for the trader to manage risk on. You know, if you close in the gap, below the gap, that's not going to feel nearly as comfortable for small cap holders here. So a close below the white line could be a reason where some traders are going to take a little bit off just based on weakness. Remember, some of you like to sell on weakness. Some of you prefer to sell into strength. Just know which of those is your preference and then work to stick to the plan. That's what we talk about in this class, at least as much as we possibly can. We try to make it black and white for us so that there's no emotion involved in our decision making. Certainly aids us in being a little more methodical in our process. And really, that is what we gain benefit from in the market. If we can stay consistent and stay consistent to our disciplined approach, then odds are in our favor that we're making proper decisions and we are not acting hastily. So here we have our opportunity to jump into our example portfolio. So let's take a look at our existing accounts, positions we maintain, and see how some of these adjustments we might need to make. Now here we've got the Halliburton trade. Let's take a look at it. I'll click my 5 here so it populates my chart. You can see the trade developed. Oh boy, we are right back to it, everybody. So far, this has played out pretty darn close to how we had thought it might, right? We had a measured move calculation or an approximation on our trade when we got in. We are looking to sell our position at 41 and a half up there. We've gotten close. You know, our high back here was 41.18. Our high today was 41.07. So we're not far. We can let this one go to try and get to the target, but at the same time, everybody, it would make sense for us to raise our stop exit here to make sure that if it doesn't jump that extra 40, 50 cents here, that we can still protect our downside below a comfortable level. We have a good amount of profit, $1,400 on the trade. We don't want a good trade to turn into a bad one. So we can do a couple of things here, everybody. One, we can simply raise our stop on the entirety of the position, which I certainly think makes sense, trying to stay one ATR right here in our notes, one ATR beneath our simple moving average of preference. In this case, that's probably the 50-day, right? Because if I pull off the 20, you'll see all the price action through the orange 20, right? But if we go with exclusively the 50-day, boy, it sure looks like the 50 has been much more consistent for us. So let's use the 50. Let's incorporate our one average true range. And let's just do a little bit of math. So here we're going to take the 36.92 50-day moving average, which I'm grabbing right from my y-axis there. And then I'm going to take the value of my average true range at the bottom. It's $1.29. And that means my new stop needs to be 35.63. Currently, we have a stop at 34.59. So this is going to be moved up by about $1, which is great. Nothing to suggest that we couldn't go a little bit tighter if you were a trader who had more comfort with the 20-day moving average and you wanted to do that. No trouble there. So we're going to do that. I'm going to right click and I'm going to say cancel replace. And I'm just going to change the numbers here to 35.63. Now remember, we can't guarantee that we get that price. Obviously, if we get triggered, we get the market price thereafter, but that's what we're striving to do, is to limit our downside. Given our entry point though, by locking in the entrance here or the exit to that level, I'm going to put on another piece of detail here just to show the trade. And so we bought it here at 35.41. So now we are very close to feeling really comfortable with our exit strategy, because while I can't guarantee it, it looks like we would be close to break even if we got stopped out. And I'll tell you, that's a good feeling for your trades. Yeah, of course, we would love to be sold at our limit up there. But at the same time, if we're going to take a loss, let's take as little of a loss as possible. So in this instance, we might be capable of breaking even on the trade, even if we get stopped out. Obviously, we're hopeful that we can get up into this ledge of resistance and sell the trade. Now, one alternative here we can also make is to alter the exit strategy. So if we're still feeling pretty bullish on this, running with our 50-day moving average, let's jump to the weekly. Okay, I'm gonna tell you what, feeling a little differently about this. Why don't we make a slight adjustment to our upside target exit strategy, and let's only sell a portion so that we have some that can continue to run potentially. So let's go back to my daily, and I'm going to change my exit from selling 275. Let's only sell 175. That way we're left with a 100-share position, and if it rallies and continues, we're still participating, okay? So hope you're paying attention here. We are just adjusting our exit strategy from all position shares, all 275. We're changing it to only 175, but we're maintaining our same limit at 41.5. So we're sticking to a strategy, but this now says if we break out and it continues to run, we're going to participate, okay? So at least this way, if we sell the 175 at our limit and it pulls back, we were right to have sold 175 at our limit. If we sell our shares at our limit and it keeps running, well, we were right to have kept some as well. This is a way you can work to manage your emotional tie to your trades, to your dollars. Hopefully this will help some of you out in your thought process as well. Okay, moving off of Halliburton, making that adjustment. Let's hit the Fastenal trade. We're in a small loss, probably aren't going to make any adjustments here. We are in at this spot. We built our exit strategy, our stop order here, based on a movement below the 50-day moving average by the amount of the ATR, the one average true range. So we are not making any adjustments here. You'll notice we got really close to getting stopped out, didn't we, everybody? We got so close to it. The low on this day was 43.52 and our stop order is 43.43. So we missed it by about 9 cents. And that's not bad on a $40 stock. So we did not get stopped out. Remember the reason we made the trade initially. We're not going to reduce our stop. We are comfortable with our risk. We'll keep the trade as is. Moving on. How about EW? Put ourselves in this one recently. We do have a nice little profit on it. Let's see if we can raise our stop. So we bought on the trend line bounce. Let's put all of them in there, everybody. So we bought on the trend line bounce, which is different than we've suggested in this class. Here, we frequently will look for stocks that are trading above all three major moving averages, that being the 20-day, the 50-day, and the 200-day. In this instance, however, what we noted was a long-term uptrend. I'll show you that on the weekly here as I zoom in a little bit. So you have this trend that began in the summer of last year, and it's been tested a few times. And we've tested again 2 weeks back and said, let's utilize this as our entrance. We went with a relatively tight stop. So we used our exit strategy, the low here at about 77, and we just built in the average true range and pushed it down by the amount of the ATR. And now it's moved in our favor. So the question now is, do we need to make the adjustment to our stop? And I think a lot of you traders are going to say yes, because we are back above the major moving averages. So I guess the question becomes, which one of these moving averages matters most for us? How do we build our ATR? So in this instance, the 20-day has been very active. It's our lowest moving average. We could work with the 20. We could also work with these lows here at around 79.15. And if we did, let's say 79.15, this would be where we would say, all right, if we closed below this by an amount of the ATR, we could go ahead and call this trade and move on. We'd probably be a little bit profitable, but ultimately our only other option is just to use the trend line. So we're kind of in a weird spot in this case. We don't have to do anything. If we wish, we can raise the stop. We have our target above for a portion of the trade, just like we did a moment ago. So on the HAL trade, but we've got an exit for half the shares at resistance up there. I'm inclined to leave this alone, and let's just see what we get out of it. You know, we're in the trade in the middle of it all, and while we've got a little bit of profit, I wouldn't mind seeing this thing rally through. Looks like we rallied off of the earnings here earlier last week. So yeah, that led to the pop. Let's go ahead and see how this goes. We will not make an adjustment today on EW, and let's hope we're in the right side of things here to watch that one keep running for us. Next up, PNC in financials. Probably aren't going to make any adjustments here. Let's see. Yeah, but I'll be honest, this actually looks like an improving chart for us, doesn't it, everybody? Because we had a beautiful gap move middle of the month. We set our levels, clearly holding support. We built our exit strategy beneath the 50-day moving average by the amount of the ATR. That's why we are here. If we wanted to make an adjustment here, believing that now the 20-day moving average is the most important detail on this chart, we could. So, you know, we could say take the 20-day, which today comes in, let's see here, 219.98. 219.98. I'm grabbing that from up above here, everybody, right in my detail right there. So as I move my cursor off, you can see in orange, 219.98, and then we add in our average true range of 485. I'm rounding up by a penny, 4.85, and that means exit strategy at 215.13, and we are currently at 212.33. So we could almost raise this by about $3. Now, the question is whether you traders would make such a move. Because the action we're looking at here seems to be validating the 20-day moving average more so than the downsloping 50, if I want to be aggressive here, I think it makes sense. Let's go ahead and try and pick up that additional of a $3 almost, and let's raise the stop to that 215.13 area, which is still going to be below the 20-day moving average, okay? But it's also going to give us a little bit more a little wiggle room, but not too much wiggle room, right? We like wiggle room, but we want a proper amount of wiggle room. And that's why we use the ATR, the average true range. So I'm going up to 215.02. You know, there is risk here because you could easily see one of those days, some broad market weakness, and maybe we sell down to the 50-day and we tag the 50-day moving average, which is at 214.78. So there's a slight bit of risk here. We're being aggressive by working with what we are working with, the 20-day here rather than the 50-day. So just a heads up to that extent. We could be increasing our likelihood of a stop out, but I'm less concerned about it. Hopefully, I'm right in the sense that the 20 days are supporting trend line going forward here, but let's see how that plays out. And then our last one, everybody, is on HPE. We did just recently add that one. It looks like we might have hit that one pretty darn well. So we were buying based on the potential breakout through this pennant formation in here, as you can see. So let me zoom in for you. So we bought based on this, and then we wanted to work with the 20-day again. In this instance, because we've been above the 20-day on PNC all the way back to mid-March. So we definitely have some comfort with the 20-day. Now, if we want, we have a couple of choices to make here, don't we? We've got a pretty interesting amount of support here over the last week, being that we bounced off of it 3 out of the last 4 sessions. So we could work with 27.37 and add the average true range beneath that. We could also take the 20-day at 26.01 and go beneath the average true range by its amount of $1.02, which will put us down there to 24.99 instead. Currently, though, we have a stop at 22.63, so we can really increase and improve our exit strategy by elevating this today into that 24.99 zone if we want to work with the 20-day. Now, that does mean we have to give up some move, right? So if, for example, the trader is comfortable using the 20-day and going to 24.99 for the exit, the 24.99 is, I mean, that's about $3. That's about a 10% drop. And this is an excellent example, once more, of why I want you all to have these conversations with yourself. Because there's a big difference between selling on weakness and then selling as it moves to the upside, right? Even from the fall right here through support, if you go with my ATR below the 20-day at 24.99, we are losing 10% before we sell. Not all of you are going to be comfortable with that. Some of you will say, you know what, that's not what I want. Why don't I put a tight stop for 25% of it up here, and then another stop on the 20 or right beneath it for another 25%, layering an exit strategy as a means of working to try and keep as much of your profit along the way. None of these are going to be perfect for all of us. That's the big reminder here, right? There is a conversation to be had. Most often, you're having it with that voice in your head. But remember that that voice in your head sometimes is speaking in a manner to sabotage us. So try and recognize it, try and catch it for what it's worth, and lean into your process. This is going to keep you from making hasty decisions. I continue to say this because I think it's so important to how we choose to manage our portfolio. So working to avoid haste in our process. So we're going to go ahead and in our process update the stop order. So from 22.63, we're going to raise this all the way up to 24.99. This one has gone really well for us. So let's go ahead and send it up to 24.99. And then notice there we are, about $1 beneath, well, $1.02 beneath our 20-day moving average as we work to capitalize there. All right, everybody. Now we do have a survey in the chat. Needless to say, for those of you who are frequent attendees here, you know I want to hear from you. Your feedback is invaluable to me. So take a minute. You can click that link right now, and you can get to it post-class. You don't have to lose any time right now. You can certainly give me some comments. Let me know what your thoughts are about expanding the class a little differently or altering our process at all. Maybe not the process so much, but I want to hear what other ideas you think could be pertinent for this class as we continue to work to just simply look for ways to add individual equity positions to a portfolio based on the groups that are moving at any given moment. And so with that, let's take a look at our Market Watch page so that we know where our opportunities might reside amongst our quote fields here. So if we look at it on a most recent 5 days, interestingly, we've had a bounce in energy. And over the last month, energy's been selling down a little bit. But you'll see on the chart, energy's held up pretty well. Now, we've had a massive move higher in technology. And so we don't have a lot of tech, if any, in our example portfolio. This might be an opportunity to look to add this exposure in technology or even in communications. So let's take a look at a couple of these charts, though, for you guys. So I'll go back to my standards. Let's put up energy. And you can see why energy might be worthwhile here as we dance on the confluence of the 50-20 moving averages here. So it's a pretty important spot. Some traders would say one day at this level of moving average potential resistance is not validating the breakout yet. And some of you traders want to see a second close, a third close in a row even. Whatever confirmation you rely on is what you want to lean into here. So for some of you, 2 days in a row is enough. 3 days in a row might be more preferred, but have that defined. Not yet necessarily in energy, but we certainly could consider it. We wanted to maybe look in industrials for a different reason. Not necessarily because it's moving higher immediately, but what it has done is consolidate beautifully after having moved higher with the broader markets, right? So we got this big gap. You'll remember it. It was a Tuesday, and we gapped aggressively higher through both the 20 and 50-day moving averages, and then now have gone sideways, have held both of those levels. So this action here can certainly be considered positive. And I'm saying this action here. Let me I want to see if I can do this with my draw tool here. I'm learning a new draw tool for you all. So yeah, this right here is what I'm talking about, right? So this ability to maintain this level after having gone sideways for 3 weeks, that is lovely to see if you're a trader. And so what it's enabled us to do is bring the 20-day moving average higher. You'll notice here when I kick these off here, the 20-day crossing the 50 to the upside. So I think maybe industrials could be a key area to check out. And let's look at, while we're here, let's also check on technology. I mentioned tech, and we've got some a clear break of our downtrend. An aggressive move to the upside could be considered to be bull flagging up here. Obviously, the catalyst is this week's earnings. So we've got a lot to hear from a number of very important Mag 7 companies with whom you're all familiar. So let's make certain here that we don't jump into something that's not necessarily primed. Doesn't mean we wouldn't find opportunities in tech, but when you see the move it's made and it is a little bit under consolidation, the question I have is, would we be better suited maybe with the trade in industrials following a consolidative window as opposed to watching a 3-week rally develop and then start to pause? All of us have our preferences in that regard. I also thought we should look at communications. Communications did seem to break the bull flag there, but we are still at basically all-time highs. So we need to see breakout there for some validation. And I'm starting to think that the two big areas to really look into today are going to be energy and industrials. Let's quickly hit up utilities and then real estate. Boy, these guys have gotten really choppy of late as we've just been back and forth, and that's an interesting look in real estate there, everybody. Real explosive move to the upside and seemingly giving you a bit of a bull flag now at this point, but not an area we need to necessarily expose dollars to. So what we're going to do is we're going to quickly go back to my scan tool. Now, normally when I'm building my preferences for this class or building out my process, I don't even use the scan tool anymore, but I do want to load up my standard for this, which is basically uptrending all time frames, which is just ensuring that we're finding stocks that are closing above all three major moving averages, the 20, the 50, the 200, and with sufficient volume to trade. When I choose to do this by default, I do it just for the S&P 500, but I have also scanned individually amongst a number of those key sectors, excuse me, in the market. And so I've got these all set up for us. We'll go to energy. And so again, what is this giving us? It's just going to show us all the stocks in the S&P 500 in the energy sector that are trading above all three of those major moving averages as of today's close. Then I can go in and, having already customized my watch list, here I'm just going to move between them and find my possible companies for consideration. And we're trying to find those that maybe haven't quite made the move, right? If we can get into some of these at a time when it appears like we might be ready to move higher, like this one in particular, ONEOK. Look, we did a nice trade on this one. Back in the late winter here, early February, we managed to trade this pretty well, but not as well as we could have. I mean, gosh, only $1 and change in profit there. And then this one we got stopped out on some aggressive pullback. Try not to go back to the well too frequently is what I often point out to myself. And I find that, when we start thinking about the trade that we missed out on, or the trade that I didn't make, the trade I got stopped out on, then I start thinking that I should be, holding that against the company itself or the stock itself. And, that stock doesn't have any knowledge of me nor any concern for me. So I'm not going to hate trade these positions. In the past, that would have been something that I would have done. But I'm long past those days, everybody. Moving on down the list here, we've got that Howell position. Could we look into Diamondback here? Yeah, maybe so. I mean, we've got a deep pullback and it rallied through it. But I'm looking for something a little more in line with maybe a possible breakout. See, there you go. Williams is almost at a breakout spot, pretty close to getting above the 50-day. Could do a buy stop on this one, maybe. Conoco, that's a little better because we've held the 50-day. And while we've got, whoops, let me zoom in on this. So while we did pull back big, boy, we pulled back just to, former resistance, potential support. And I'll bet that that's akin to the 50% pullback that the whole energy space got. Let's do a quick Fibonacci from January, the low on the open of the market in the year. So that would have been January 2. Let's see here. Yeah, there we go. So this is when the year began and energy started to rally. And I did this in an X post today, looking at the move energy made. And sure enough, the move that Conoco made is right in line with the sector. So that's pretty intriguing. Pulled back 50% of its upward move. Now it's rallied and held the 50-day for the last 5 sessions, almost 6 sessions, 6 closes. So now maybe Conoco is the winner here. Let's look at that. Let's add a position in Conoco. I'm going to remove my Fibonacci draw tool here. All right, let's add a position in Conoco using the 50-day moving average and the ATR. Now, it's not to say that we couldn't revisit that same low back here. We surely could, but you know what? If energy is in fact back in gear, then maybe we have more to look for. And I don't disagree with what you're saying there, A-Trades. Energy could, and I think I'm starting to wonder if the sell-off in energy is over, because I think the market believes the war is essentially over. The reaction to war headlines is more muted and more muted by the day. So I'm starting to wonder if the market's already past that. Now, energy might not be past that. Remember, even the completion of all of this concern could leave us in a scenario where it's going to take 6, 9, 12 months or longer for things to get back to relative normalcy, whatever that means. So keep that in mind. I don't know, you're not wrong, but at the same time, if we're buying into the trend, the 50-day moving average here has held. I think that there's plenty of validation over the last week plus to maintain the 50-day moving average, and we're going to see if it holds. We've got a good one on with Halliburton. Let's see if we can do something akin to that here with Conoco. So Conoco's entrance is going to be basically at market open tomorrow morning. We're going to use 121.10 minus the 388 for the ATR. And that means an exit at 117.22. Here we cannot, we don't want to go with a full position. So I'll just remind you of our process. We don't want a full 10,000 necessarily. So we'll do about, let's see here. Well, 25 shares should be a good starting spot. So let's see if we do a buy with a stop and change this to 25. Update that. Okay, so a buy stop tomorrow at a limit. We'll go up to 125, remembering that we do not pay 125 if we open lower than that. Our exit strategy, we have to kick to good till canceled, of course, and 117.22 becomes our exit on the stop. Now, our entrance cost, right around 3,100. This is perfectly appropriate because if we do end up losing about $8, that's going to come out to about $200. We will look and consider adding to this if we have good reason to do so in subsequent sessions here, everybody. But we're going to start small. Let's see if we can get this one to move for us, okay? So that one's set up for tomorrow's session, Conoco. And then I had some in industrials. So I'm going to go back to my personal watch list, uptrending all time frames and industrials, and opening that list up, I found two that looked kind of interesting. One, and again, be mindful. Yes, it's always more fun and more comfortable to buy on a green day, but sometimes buying on red days is the way to go. And I found this Expeditors International here. And again, we're more focused on sector relationship than anything else. And I'm watching the action on this one. And again, this is all about this stuff over the confluence of the 20 and the 50 right here. So we've basically broken, this zone like so, and have now held it. This looks like a great spot to place an order as long as we incorporate our exit right beneath it, right? So we're going to use the 50-day here. The 50-day is 145.44, okay? And our ATR on this one is 307. And that means a strategy of exit around 142, 142.37. Now, look at this last low. And these last lows are in the same vicinity. Now, you as a trader, you might say, I want to go under those lows because those are still potential bounce levels, right? And that line is at 142.23. Maybe the trader wants to go below there just to be safe. Many of you would also say, Kev, I'm still going to go deeper. Put me under the 200-day. That's fine too. Just do the math. Make sure your position size is proper if you're going to risk, from an entrance at 147 all the way down to 137. Make sure you tighten up your share totals if you're going to give it more berth. So here, down to 142, it's only about a $5 level of risk. And we can risk up to 1,000 shares, $1,000, excuse me. So that'd be no more than 200 shares, but that's a huge position on this account. So we're going to keep it relatively reasonable, not to exceed 50 shares. So we'll do a buy custom with stop, and we'll do it for 50 shares. And that limit will be 148. So just giving it, again, a little padded limit, as I like to call it, for tomorrow's business. It is good for tomorrow only. So if we don't get into it tomorrow, then we don't have a trade for next week, okay? So just bear that in mind. Again, our stop is good till canceled, and that comes in at 142. Now, I stated 142.37 here, everybody, but I'm going to go a little deeper. I want to make sure that we get under those last lows that were at that 142. Let me see there, 142.22, 142.42. Yeah, so we're going to go beneath 142, a little bit. So down to maybe 90. I always like 94. It's a good year, real good year. All right. So buy 50 shares, EXPD, a limit price not to exceed 148 tomorrow. Exit strategy on the downside only. Protective stop. Triggers at 141.94, becomes a market order to sell thereafter. No guarantee of price. Our position size, probably not one we can end up adding to necessarily, but this looks interesting. We might get a quick bounce out of this one here in short order. Note that we do also have earnings coming here, by the way, coming up on, according to this, if I can get the highlight to tell me. There we go. I think it's coming up first week of May. Well, it doesn't want to hover for me right now, everybody. So we'll figure that out. That's going to annoy me, though. There it is, 5-5. May 5 ahead of market open that day. All right. Now, in that same space, I thought we had one more chart that looked interesting, and that is Parker Hannifin, PH. And I think you can see why, everybody, because this is essentially following the same process and same chart pattern as we saw in the entirety of the industrial sector, right? So here, I'll put that line in, and then we just bring you back to the industrials here. So there's PH, and then there's your industrials. Those charts look pretty eerily similar, don't they? So this one could be very much in line with everything we just talked about. Our low in this period is basically the low we had on the gap day. That day, the low was 950.81. And so if you were so inclined to place an entrance here on a small trade, and it might have to be, like 5 shares, kind of small, maybe the trader goes beneath that 950.81 by the amount of the ATR, which is nearly $27. I'm going to round that up to 27. And that says a stop order around 923.81. Now, the 923 is below the last levels in here. It would be a real significant break of the 20-day moving average. So that could make some sense. And then let me just mention, as it relates to the average true range, the reason behind the use of the average true range is we are comfortable selling the stock we buy based on weakness of the stock itself. Okay, and one of the things that the ATR can help us do is reduce the ability of the stock to take us out on moves that are not really moves that the stock should be making. And what I mean by that is, a bad day in the market collectively, you're going to see a lot of stocks selling off. But not every stock that sells off is going to sell off beyond their average true range. Very commonly, if they are just selling on the rest of the market selling off, commonly those sales get lesser, they shrink out, right? And the sellers of those positions just move on and do other things those days. And if you can use the ATR consistently, what you'll see is that those machinations in market movement like that, they will keep you in your positions a little bit longer. We know they can't guarantee it, but we're just taking steps to increase the likelihood. Remember, that's all we traders are doing 100% of the time. We're taking steps to increase the likelihood the trade goes in our favor, because market movements, it's all about possibilities and probabilities, never certainties. So build that into your own process. Find the levels and comfort zone that you have for yourself. For a lot of you traders coming in here frequently and joining me weekly, it's 1 ATR, but don't hesitate. Play with that. If you want to use 1.25 ATR, 1.5, even twice the ATR, cool, but define it for yourself. All right, we're going to have to wrap it there, everybody. We did get that survey in the chat. Take a minute if you don't mind. Let me know how we do in this class in particular. Click that link. Let me know your thoughts. Hit that thumbs up for us down below. That always feels like applause, as my friend Cameron May likes to remind you all. And don't forget to follow Connie and me on X, Connie Hill, CS, Kevin Horner, CS. I'm also there on LinkedIn as well. And remember, I'll get this one reviewed for you after making a few notes and into the archive shortly thereafter. So anything you'd like to check out, hit the archive and a rewatch. And I'd love to hear from you if you've got any questions. So with that, have a great rest of your Tuesday. We look forward to catching up with you all again real soon.